segment. It's yield curve analysis inversions. Michael, we're going to take a look at what the yield curve normally looks like, what it looks like when it's inverted, what our yield curve today looks like, and then conclude with how you could potentially take action there. Mikey, why don't you kick it off with what a normal yield curve looks like and let the people know what they're looking at here in terms of 2-year, 10-year, and 30-year US Treasury yields.
Sure. So beautiful depiction of the yield curve here. Great artistry by Frank. What we're looking at is the duration or the time to maturity for each of these bonds, 2-year, 10-year, and 30-year, and then their respective yields on the y-axis, with the general idea being that the longer you hold a debt instrument, the higher yield you should receive. So these short dated interest rate products, 2 years, have a lower interest rate. 10 years should have a higher interest rate because you're locking your money up for a longer period of time. And 30 years have the highest interest rate because it's the longest period. Generally, this is how the yield curve should look. It's upward sloping. It's not linear per se, but it does have this upward slope to it, meaning the longer you lock up the money, the higher your rate of return should be because of uncertainty, inflation, growth expectations, all of that stuff.
Exactly right. And a great explanation. And just for those at home who are maybe thinking like, well, what's the difference between yield and interest rate? They're the same exact thing. And so when you talk about US Treasury yields here and you're like, how does this have anything to do with my life? You could think about it from a practical standpoint. Interest rates on anything that you take out in the debt world, where it's like, mortgage rates or car loan rates or whatever it is, it's got a similar structure whereby, if I take it out for, more and more time here, I would expect the rate on it to be a little bit higher based on that duration. Whereas if I was going to pay it off in a relatively shorter amount of time, that rate should theoretically be lower. This is the theoretical yield curve that we use for all parts of our lives. The benchmark is US Treasury yields, which we're looking at here today, in which we trade. We have access to trade as like a big benchmark at the end of the day for yields or interest rates being in the same exact world. So that's the theoretical normal environment. An inverted yield curve, Mikey, would mean that a shorter term debt instrument has a higher interest rate than a longer term one. And this is a pretty classic scenario that maybe you can walk people through here, whereby the 2-year is at, let's say what it might come to recently, where the 2-year right now is at about 2%. The 10-year could be at maybe 1.9 or 1.8%. And then the 30-year maybe is at 2.2%. Walk the people through inversion here.
Sure. So you've depicted here the classic inversion, which is the 2s, 10s, and it's cited all in news headlines. I'm sure you're going to hear about it in Bloomberg next week after we talk about it here. But the idea being that short-term rate expectations are higher than longer-term rate expectations. And this can happen for a number of reasons, but one of them potentially is that the Federal Reserve, the FOMC, Fed Open Market Committee, has direct kind of power over short-term interest rates. And a lot of times that's reflected in 2-year interest rates. What they don't have a whole lot of the power over is 10-year interest rates, which are driven by inflation expectations or growth expectations. So a lot of times you'll see these inversions when really there's like some fear in the market or some heightened uncertainty where the 2-year rates will get kind of bid up by participants or the FOMC potentially trying to rein in inflation. And 10 years, don't necessarily catch up. So you have this flippening or this inversion where you actually get paid more on short-term rates than you do on medium or longer-term rates. That's basically it.
And you used a key word there, which is like this, an inverted yield curve is almost always synonymous with like economic turbulence or fear, whereby this is a classic scenario where like inflation's kind of maybe getting close to out of hand and the Fed's got to step in and really hike short-term rates. Whereas in the 10-year and 30-year, those rates aren't screaming off the page like short-term rates are because the fear is kind of short. And even Fed Chair Powell, when they hiked this week, was like, yeah, we see the short-term rates, getting up to 2% or maybe a little bit higher than 2%, and then kind of like solidifying, stabilizing down closer to 1.5% to 2%. So he's even saying in the next couple of years, we might need to hike a lot in the next year or so, but then probably stabilizing in the long term a little bit lower. But that fear and this type of action is usually short term. And that's why I, as a trader, like to get on the other side of these inversions. Where we currently are at, Mikey, is just a really flat curve whereby everything is still normal. 2 years are lower than 10 years, which are both lower than 30 years. But you've seen this 2 year and 10 year start to get closer and closer together. And what that looks like in terms of prices that you can trade is this is the difference between 10 year and 2 year yields. You can see in 2021, for the majority of it, more than 1% difference, which is, correlated to this price being 1,000 to 1,600, 1.6%. Right now, under 200, which is just 0.2%, getting really close to, if this goes negative, that's an inversion whereby 10-year rates are lower than 2-year rates. So we're heading toward that inversion here. Historically, Mikey, when we've gotten down here, the last time that we went, I think, inverted for legitimately like a couple of days was in the latter part of 2019 and bounced right back off of that inversion. And we don't stay here for long. And that's why I kind of like to get on the other side. I like to put on the anti-inversion trade, which would be, buying that 10-year and selling that 2-year on this exact chart, bouncing back.
Exactly. I love it when you depict it this way because it looks like just another asset price. And you'd say, wow, this thing has really taken a hit from 1,600 down to 200. And it makes it's just an easier way to kind of trade it and to visualize it. It's almost like a mean reversion trade. I mean, there is kind of a normal difference between 2 years and 10 years and 30 years, that normal curve structure of the Treasury yield curve. And when we get down to some of these really low levels, it's hard not to dip your toe in the water. And I just took a fill in this position for $1.84. So never been easier to actually trade the yield curve with the small interest rate products from the small exchange, and a great trade idea you've outlaid in front of us today.